The nuclear disaster in Japan is impacting many energy stocks and commodities, and our next guest is making an even bigger bet on uranium now. Evan Smith is the co-manager of the U.S. Global Investors Global Resources Fund. It's a Bloomberg Best Fund that had a 38% return last year. Welcome to the show, Evan. Talk to me.
Good morning.
Why are you doubling down on uranium?
Well, we think we've been presented a pretty good opportunity just here in the near short term because of this terrible accident. You've seen a big sell-off in uranium prices, as well the companies that mine and process uranium. But for the long-term investor, the real long-term trends are for more nuclear development, particularly in emerging economies like China and in Russia. And I don't think this is going to derail their long-term plans. So we see a big opportunity.
When you say you're finding opportunities, are you looking at the companies that are mining for the uranium? Are you looking at the companies who are building reactors?
Well, principally miners, though we do have some exposure to some of the engineering construction companies that are involved, or at least provide some support to building nuclear reactors, but principally the mining companies such as Cameco or Paladin Energy.
Mm-hmm. And I understand that these prices are depressed at the moment because of the fear in the wake of the disaster, but how much of a return can you really expect, given that at a minimum we're going to see some sort of increased regulation in the United States and theoretically elsewhere, like China, where they've tapped the brakes a bit on their development of new reactors?
Sure, there are some safety regulations that will be reviewed, but I don't think you're going to see any meaningful decline in the number of new reactors built over the next 5 to 10 years or so. And that's really going to be the key driver. And because of that, we see this just a good opportunity to add or to initiate positions because of this volatility.
Now, as of December, the end of December, among your top holdings, you had a Brazilian oil company. HRT is your top holding. Is it still?
It still is. We're bullish on oil, and we see this as a substantial opportunity in the offshore exploration area off the coast of West Africa. Tremendous amount of potential resource there. The company will start drilling later this year, and we think there's a potentially enormous amount of oil there.
So you're more interested in HRT's African operations than their Amazon project?
Well, the biggest potential, really elephant-size finds are going to be probably off West Africa. They do have some development and exploration in Brazil, which we think is promising. But what could really make the company is what's offshore Africa.
And it seems like most of your fund, yes, you're in energy, but you're also looking at the miners. You're looking at the metals as making up a good portion of return as well. How much farther do you think silver and gold have to run here?
We think higher. We're seeing a little pullback, a little correction today, I guess, on some of the economic numbers. But gold has been well supported up around the 1,400 area. We continue to think it's going to move higher. Silver looks to be very attractive. We think that could even move to $50 an ounce. The precious metals look very attractive to us, and we continue to think those will work higher.
So the bottom line is you seem fairly bullish on a global economic recovery here.
For some of our exposure, I'd say that's very correct. We do think that's what's driving oil. We do have a strong weighting towards oil. Upstream oil and gas producers, oil services companies. We think oil is well supported at 100 and probably higher. But we like the metals and mining side as well, providing the metals for infrastructure build out, for urbanization in emerging markets. We think it's a long-term trend that saw a little setback in 2009, but it's right back on trend because it's a long-term trend that is difficult to slow down.
Well, besides the economic bet there, I mean, you also have geopolitical risk adding to the run-up in the price of the commodity, but perhaps there is a risk to earnings. Schlumberger just out today saying that they are seeing disruptions because of what's happening in Libya, what's happening in Egypt. I mean, at what point are some of these bets a little bit more risky because of the unrest?
That's a good point. I think that's somewhat short-term in nature, and if anything, it's supportive of higher oil prices, right? Because of the geopolitical unrest in North Africa and Middle East, and potentially more unrest. I think what you're going to see, and some of that could be weather as well. We had a lot of problems with weather early in the first quarter here in North America, but with $100 plus crude oil. And you're going to see record, probably double-digit gains in oil services spending on a global basis this year and probably next year as well. And it's going to benefit not only higher revenues, higher margins, and better profits for the global oil services companies. So we think that the oil services area is quite attractive.
All right. Evan Smith, U.S. Global Investors, thanks for joining us.